Hey everyone, and welcome back to the Deep Dive. Today we're going to dig into a company that's been making some serious noise in the power and distribution transformer market. We're talking about Shilchar Technologies. And we've got a whole stack of stuff to go through, investor presentations, quarterly reports, even a credit rating report.
Sounds like we've got our work cut out for us.
We do. This company has seen some crazy growth lately, and we're going to figure out what's driving it, and more importantly, is it going to last?
Yeah, that's the big question, isn't it? Is this a temporary blip, or are they really onto something?
Exactly.
Well, one thing that jumps out at me right away is that they've been around for a while, since 1986, to be exact. So this isn't some fly-by-night operation.
That's right. They've been steadily building expertise for decades.
Exactly. This isn't some overnight success story. They've been laying the groundwork, and now it looks like they're reaping the rewards.
It's like they were quietly building a rocket, and now it's finally blasting off. And speaking of rockets, they've cleverly positioned themselves in the booming renewables sector. Think solar farms, wind turbines, all that good stuff.
They've tapped into a powerful trend, for sure.
Big time.
60% of their business is tied to renewables. They're manufacturing transformers specifically designed for this sector.
Which is a really smart move considering the global push for clean energy.
Absolutely. It's not just about jumping on the bandwagon. They're providing specialized solutions for a rapidly growing market.
And they're not just sitting back hoping the orders roll in.
Yeah.
They're actively expanding their capacity to meet this growing demand.
Mm-hmm.
In fact, their Q1 FY25 presentation highlighted a major jump from 4,000 MVA to 7,500 MVA back in August of 2024.
Wow, that's a pretty significant increase.
It is, wouldn't you say?
It shows they're not afraid to put their money where their mouth is.
Exactly.
And you can see the impact of this expansion already. Their Q2 results are out, and they're posting some pretty impressive numbers.
Really? Let's hear it.
Both year-over-year and quarter-over-quarter growth have been driven by a significant production increase. They're riding this wave of momentum, and it's pretty exciting to see.
So they're growing like crazy, but the question is, can they keep up with this demand?
Right. That's the million-dollar question.
Well, their latest con call offers some interesting insights. Management is projecting a turnover of 750 to 800 crore once they fully utilize their new capacity in FY26. But get this, even that might not be enough.
Really?
They're already hinting at further expansion.
Wow. That's a sign of serious confidence. But it also raises the question of just how sustainable this growth trajectory is. To really understand that, we need to take a closer look at their financials.
Let's get down to the nitty-gritty then. Looking at their investor presentations, the revenue growth over the past 5 years has been phenomenal. We're talking a 54% compound annual growth rate, or CAGR for those who love acronyms. Essentially, it means they've been growing their revenue at an average rate of 54% each year for the past 5 years.
That's the kind of growth that gets investors buzzing.
For sure.
And it's not just empty growth. They're incredibly profitable, too. Their profit after tax, or PAT, has grown at a mind-blowing 180% CAGR over the same period. This is where you see the real magic happening. They're not just bringing in more revenue, they're becoming more efficient and profitable as they scale.
Okay, so you're telling me that not only are they growing at an impressive rate, but they're also getting much better at making money from that growth. That's a powerful combination.
It is indeed.
And let's not forget their margins. They hit a 29% EBITDA margin in FY24. EBITDA stands for earnings before interest, taxes, depreciation, and amortization. It's a measure of a company's overall profitability. So 29% EBITDA margin means they're keeping a healthy chunk of their revenue after covering their operating expenses.
They're running a tight ship.
For sure.
And it's reflected in their strong cash flow. They're generating enough cash to fund their growth without taking on a ton of debt.
That kind of financial strength is huge in a rapidly growing market.
Absolutely. It gives them a lot of flexibility.
So they've got the revenue growth, the profit growth, the margins, and the cash flow. It sounds like they're hitting all the right notes, but numbers only tell part of the story. What's the word on the street?
Well, their recent con call and credit rating report shed some interesting light on these impressive figures. For instance, Alay Shah, the managing director, is brimming with confidence about demand continuing for the next 4 to 5 years.
That's great to hear.
He's bullish on both domestic and export markets, which is a good sign. It shows they're not just relying on one region for growth.
Makes sense, spreading the risk.
Exactly.
And it's not just the management team feeling optimistic. Care Ratings recently upgraded Shilchar's rating.
Oh, wow.
Which is a big vote of confidence from an independent source. They specifically cited Shilchar's impressive growth and rock-solid financials as the reason for the upgrade.
It seems like the experts are taking notice.
They are indeed. So what's the secret sauce behind Shilchar's success? They're clearly doing a lot of things right. What's setting them apart in such a competitive market?
Well, for starters, they've adopted a lean and mean approach to operations. They're outsourcing lower value add components like tanks and radiators, and focusing their expertise on assembling high-quality transformers.
So they're basically saying, we're really good at putting together these complex machines, so let's focus on that and let others handle the parts that aren't as critical to our success.
Exactly. It's a classic case of sticking to your core competencies and leveraging the expertise of others.
Makes sense to me. What else is contributing to their winning streak?
They've also built a stellar reputation for quality and service, which you can see reflected in their high repeat business and growing order book.
Customers trust them, and that's a powerful asset in any industry.
Absolutely. It's like they're the go-to tailor for transformers. People know they can rely on Shilchar for a perfectly fitted solution delivered on time and with exceptional quality.
Exactly.
And speaking of delivery, they're known for beating competitors on lead times, which is a huge GE advantage in a market with such high demand.
When customers are clamoring for your product, being able to deliver quickly is a major differentiator.
It is indeed.
All right, so Shilchar seems to be firing on all cylinders. They've got the growth, the profitability, the reputation, and the speed. But we all know that no business is without its challenges. What are some potential bumps on the road for Shilchar?
Well, one thing that stands out is the rising competition. The market is heating up, with existing players ramping up production, and new entrants eager to grab a slice of the pie.
It's like a game of musical chairs. Everyone's scrambling for a seat, and when the music stops, someone's going to be left standing.
Right, exactly.
So how does Shilchar plan to stay ahead of the competition and keep those profit margins healthy?
That's a great question, and it's something we'll delve into in part 2 of this deep dive. But for now, let's take a closer look at another potential challenge they highlighted in their con call: the global transformer supply shortage.
Right. They mentioned this shortage is actually working in their favor right now. It's driving up demand and allowing them to command premium pricing. But what happens when the supply catches up with demand? Could that create a sudden shift in the market dynamics?
It could, and that's a risk they need to be prepared for. What if demand softens or competition intensifies just as supply increases? That could put a dent in their growth plans.
It's a delicate balancing act. They need to capitalize on the current favorable conditions while also preparing for potential shifts in the market.
Absolutely.
And there's one more thing we need to consider, and that's the volatility of raw material prices.
Oh, right. They did mention that they've been navigating raw material price fluctuations pretty well so far.
They have, but any major supply chain disruptions or price spikes
Yeah.
could impact their ability to fulfill orders on time and maintain their profit margins. So how are they managing this risk? What strategies are they employing to ensure a stable supply of raw materials at reasonable prices?
Well, that's a question we'll explore further in part 2. For now, let's shift our focus to some of the more granular details from their recent performance, particularly their latest con call and quarterly numbers.
Okay, let's unpack those numbers. Their Q2 results show that they're exceeding expectations on multiple fronts. Their revenue from operations jumped by a solid 23% year over year, and their EBITDA margin expanded to an impressive 31%. They're not just growing, they're becoming more profitable as they scale.
And that production increase they touted in September, it's clearly playing a significant role in this growth.
It seems like that capacity expansion is working exactly as planned.
They're firing on all cylinders.
Their order book is also a fantastic indicator of future growth. At the end of the quarter, they had a healthy backlog of 450 crore rupees, which they expect to execute within the next 6 to 9 months.
So they have a pretty clear runway for continued growth in the coming year.
It seems other customers are lining up to place orders, and that speaks volumes about the trust they've built in the market.
It does, and it's important to remember that around 60% of their business comes from the renewable energy sector. This alignment with the global shift towards cleaner energy sources positions them perfectly for long-term success.
It's like they're riding the wave of a powerful trend, and they're holding on tight. But let's dive a bit deeper into their customer base. The con call revealed some interesting insights into who they're selling to and how they're managing risk.
Oh, I'm all ears.
Well, for starters, they mentioned that they primarily serve private sector clients,
Interesting.
which helps them mitigate credit risk and maintain a shorter collection period. They're not waiting months to get paid, which is crucial for maintaining a healthy cash flow.
That's a smart move.
It shows they're not just chasing growth at any cost.
Yeah.
They're prioritizing profitability and financial stability.
It's like they're saying, we want to grow, but we want to grow smart.
Exactly. Now, their commentary on the global market during the con call was quite insightful. They acknowledged the increasing competition from both established players and new entrants, particularly in the export market.
It's a crowded playing field out there.
It is, and they're not shying away from the challenge. They emphasize that building trust and a track record is absolutely crucial for success in these international markets. It's not enough to just show up with a good product. You need to earn the respect and confidence of customers in these new regions.
Reputation is everything.
It is.
And it sounds like they've put in the hard work to establish themselves as a reliable partner.
They have. They also touched on the challenges of CRGO steel imports, which have been impacted by BIS restrictions. CRGO steel, or cold-rolled grain-oriented steel, is a specialized material that's crucial for manufacturing high-efficiency transformers. And the Bureau of Indian Standards, or BIS, has implemented stricter regulations on imports of this material.
So it's a potential supply chain bottleneck.
It is, but here's the good news. They assured investors that they've secured their supply of CRGO steel and are not facing any immediate shortages.
That's a relief.
It is.
Yeah.
They're not letting these challenges derail their growth plans.
They're proactive about managing these supply chain complexities. They mention their practice of immediately booking raw materials upon receiving orders. This helps them mitigate the risks associated with price fluctuations. They're not waiting around for prices to go up. They're locking in their costs and ensuring a smooth production process.
It sounds like they're running a tight ship with a keen eye on both the big picture and the small details.
They are, and that's reflected in their consistent focus on achieving high margins. Their investor presentations highlight this commitment to profitability. They're not just chasing growth for growth's sake. They want to grow profitably and sustainably.
Absolutely. And their impressive EBITDA margins, consistently above 25%, are a testament to their operational efficiency and cross-management. They're making money, and they're making it well.
And they're not afraid to invest in the future. Their recent capacity expansion is a clear sign of their commitment to growth, but they're also being strategic about it. They indicated that they'll consider further expansion only if the industry scenario remains positive. They're not going to overextend themselves if demand starts to soften.
It's a measured and calculated approach.
Exactly.
And remember that point they made about having enough land for potential future capacity increases.
Oh, yes, that's a good point.
That's crucial. It means they have the flexibility to scale their operations significantly if the market conditions warrant it. They're thinking long-term, and they're prepared for future growth.
That's right. But they're not just relying on organic expansion. They're also exploring new markets like Europe. They recently secured their first order from Europe and are optimistic about growing their presence in this region.
It's a smart move to diversify geographically, especially as competition intensifies in their existing markets. They're not putting all their eggs in one basket.
Exactly. They're spreading their wings and exploring new horizons.
Now let's switch gears and delve into the credit rating report from Care Ratings. This report provides a valuable independent perspective on Shilchar's financial health and growth prospects.
Okay, let's see what the experts have to say.
Care Ratings recently upgraded Shilchar's rating, citing their impressive financial performance, strong growth trajectory, and robust order book.
This is a huge endorsement from a reputable independent source. It adds another layer of credibility to their story.
It does.
Care Ratings highlighted their robust capital structure with zero outstanding debt. This gives them a significant advantage in an industry where many players are heavily leveraged. They're not burdened by debt payments, which frees up more cash flow to reinvest in the business.
And their debt coverage indicators are phenomenal. They have an interest coverage ratio of over 500 times, which is just incredible. This basically means they're generating enough profit to cover their interest expenses many times over.
That's a sign of exceptional financial strength.
It is.
Care Ratings also acknowledged their experienced management team, led by Alay Shah, who has over 3 decades of experience in the transformer industry.
This depth of experience is invaluable, especially in a complex and rapidly evolving market.
Absolutely. They've seen it all, and they know how to navigate the ups and downs of the industry.
It's clear that their expertise is playing a key role in their success. They're making smart decisions about capacity expansion, product development, and market strategy. But Care Ratings wasn't blind to the potential risks.
Right. They pointed out that Shilchar operates in a niche and competitive industry. They also mentioned the potential impact of raw material price volatility and foreign exchange fluctuations. However, they acknowledged that Shilchar has been managing these risks effectively so far.
It's reassuring to see that they're not ignoring these challenges. They seem to have a realistic view of the market dynamics and are taking proactive steps to mitigate potential risks. Now let's bring it all back to the big picture. What does all this mean for someone considering investing in Shilchar Technologies?
Well, on the surface, Shilchar looks like a fantastic growth story. They're riding the wave of the renewable energy boom, have a strong financial track record, and a clear vision for the future.
Their capacity expansion is paying off, and their order book suggests this growth is likely to continue. But as with any investment, there are always risks to consider.
The key question is whether they can sustain this incredible momentum. Can they maintain their high margins as competition intensifies? Can they navigate potential supply chain disruptions and global economic headwinds?
That's a lot to think about. But that's what makes this deep dive so valuable. It's giving us a comprehensive understanding of Shilchar's business, their opportunities, and the challenges they face.
Absolutely.
And in part 2 of our deep dive, we'll continue to unpack these questions and delve even deeper into the factors that will determine Shilchar's long-term success. So stay tuned. Welcome back to the deep dive. We're picking up where we left off with Shilchar Technologies, a company that's really electrifying the transformer market with their impressive growth.
Yeah, in part 1, we talked about their revenue and profit surges and their smart focus on the booming renewables sector.
But we also left off with some questions about the challenges they face.
Right, things like competition heating up and the possibility of that transformer supply shortage easing up, both of which could impact their pricing power and growth trajectory.
Exactly. So let's tackle that competition question head on. How can they maintain those juicy profit margins when rivals are breathing down their necks? What's their game plan?
Well, one thing that stood out to me from their con call and investor presentations is their emphasis on customization. They're not just churning out cookie-cutter transformers. They're tailoring their products to meet very specific customer needs.
So they're like the bespoke tailors of the transformer world,
Right.
creating custom-fitted solutions for each client.
Precisely. And this made-to-order approach, as they call it, allows them to command higher margins and build those strong customer relationships we talk about. It's all about adding value beyond just the product itself.
It makes sense. If you're getting a transformer that's perfectly tailored to your needs, you're probably willing to pay a premium for that level of customization and expertise. But this approach must also add complexity to their operations, right?
Absolutely. Think about it. They need to manage a diverse supply chain, ensure top-notch quality control across a wide range of product variations, and coordinate production to meet different delivery timelines for each client.
It's logistical juggling act.
It is.
It's like they're conducting an orchestra, making sure each instrument plays its part perfectly at the right time. It's impressive how they're able to maintain this level of agility and responsiveness while scaling up so rapidly.
And speaking of scaling up, they're already onboarding and training new talent, streamlining their production processes at the new plant, and grappling with the challenges of rapid growth. It's not always smooth sailing, but their ability to manage these growing pains will be key to their continued success.
Now let's talk about their reliance on the renewable energy sector. It's been a winning bet so far. But is it sustainable? What happens if government policies change, subsidies dry up, or the pace of renewable energy adoption slows down? Are they putting all their eggs in one basket?
That's a valid concern. They've hitched their wagon to the renewable energy star, and for good reason. But it's smart to consider what happens if that star starts to fade. Government policies can be unpredictable, and technological advancements can disrupt even the most established industries.
It's like they've built their house on a foundation of solar panels. As long as the sun keeps shining, they're golden. But what happens if a few clouds roll in? Do they have a backup plan?
Well, that's where their decision to primarily serve private sector clients comes into play. It helps them manage credit risk and ensures a steady cash flow, as we discussed earlier, but it also potentially limits their market reach. What if they miss out on those big contracts with state utility companies or government-led renewable energy projects?
It's a trade-off they've clearly made. They're prioritizing profitability and financial stability over pursuing every possible growth avenue. It's a conservative approach, but it seems to be working for them so far.
And that debt-free balance sheet they boast about gives them the flexibility to weather economic storms and seize opportunities when they arise. They're not beholden to lenders or investors, which allows them to make strategic decisions without external pressures.
It's like they've built their own financial fortress with a moat full of cash flow and walls made of strong margins. It's a pretty enviable position to be in. But let's not forget about their international ambitions. They mentioned strong demand from export markets, particularly in North America and the Middle East. And that first order from Europe is a promising sign. But breaking into new markets isn't a walk in the park.
Definitely not. They'll need to navigate different regulatory environments, cultural nuances, potentially even language barriers. It adds a whole new layer of complexity to their operations.
It's like they're learning a new dance routine. But this time, they have to adapt it to different rhythms and tempos. It requires flexibility, coordination, and a deep understanding of the nuances of each market.
And let's not forget about the competition they'll face in these international arenas. They're going head-to-head with global giants who already have established networks and relationships in these markets. It's not just about having a good product anymore. It's about building trust, understanding local market dynamics, and providing exceptional service.
It's like they've entered a new culinary competition, and they're up against seasoned chefs who know all the tricks of the trade. They'll need to bring their A game to stand out in this crowded field.
And they mentioned in the con call that lead times in the export market have increased slightly, which could put pressure on their ability to meet those tight deadlines they're known for. Maintaining their reputation for speed and efficiency will be crucial as they expand internationally.
Right? It's one thing to promise quick turnarounds, but it's another to actually deliver on those promises when you're dealing with the complexities of international shipping and logistics. It's a challenge they'll need to address head-on.
And let's not overlook the impact of currency fluctuations. They generate a significant portion of their revenue from exports, which makes them vulnerable to exchange rate volatility. A sudden shift in currency rates could eat into their profits.
It's like they're playing a financial game where the rules keep changing. They need to be nimble and adaptable to navigate these unpredictable currency markets.
But to their credit, they seem to have a solid understanding of these challenges and are taking a measured approach to their international expansion. They're not rushing in blindly. They're doing their homework and building a solid foundation for future growth.
It sounds like they're playing the long game, which is a smart move in a market as dynamic as this one.
Exactly. And that brings us back to their production capacity. They're aiming to fully utilize their new capacity in FY26, which they believe could potentially lead to a turnover of 750, 800 crore rupees. That's a huge leap from their current revenue. It suggests they're anticipating continued strong demand for their products. But it also begs the question, what if that demand doesn't materialize as they expect?
Right. What happens if those orders don't come flooding in? Will they be left with excess capacity, forcing them to lower prices and potentially hurting their margins?
That's a valid concern, but their investment in a new plant capable of handling transformers up to 50 MVA and 132 kV class suggests they're confident in their ability to attract larger, more complex projects.
So they're not just aiming for quantity. They're targeting bigger, more profitable projects. It's a bold move, but it could pay off handsomely if they can secure those contracts.
And let's not forget about their lean and mean approach to raw materials sourcing.
Right. They outsource those lower value-add components like tanks and radiators and focus their expertise on assembling those high-quality transformers. It's like they're saying, we're the master chefs and we're going to let others handle the chopping and prepping.
It's a smart strategy that allows them to maintain flexibility, reduce their capital expenditures, and leverage the expertise of specialized suppliers. But it also makes them reliant on the performance of their supply chain. If their suppliers experience disruptions or quality issues, it could impact Shilchar's production and delivery timelines.
That's a valid point. They've mentioned that they're not facing any immediate supply chain issues, but the recent BIS restrictions on CRGO steel imports highlight the potential for disruption.
And let's not forget the volatility of key raw material prices like copper and transformer oil. Any significant price increases could eat into their margins.
But they're not just sitting back and hoping for the best. They mention their practice of hedging their raw material purchases, which helps to mitigate the risk of price fluctuations. They're being proactive and strategic in their sourcing and procurement processes.
Absolutely. Now let's shift gears and take a closer look at the people behind the numbers. Their management team seems to have a solid mix of experience and fresh perspectives.
Right. Alay Shah, the managing director, has been in the industry for over 3 decades. He's clearly the driving force behind their success. He brings that deep understanding of the market, the technology, and the nuances of the business.
But what's interesting is that he's brought his sons Ashay and Atman into the business. They bring new ideas, a different perspective, and a passion for innovation.
It's a classic case of blending experience with youthful energy.
It is.
It's like they've created a family recipe for success, combining the wisdom of the elders with the zest and innovation of the younger generation. And it seems to be working.
And it's worth noting that they're actively investing in their workforce, onboarding and training new talent to keep pace with their expansion plans. They're not just building a business, they're building a team.
That's crucial for long-term success. You can have the best products and the smartest strategies. But without a talented and dedicated team, it's all for naught. They're clearly recognizing the importance of their people, which is a great sign.
Now, when we look at their overall vision for the future, they haven't laid out a specific 5-year plan or anything like that, but their actions speak louder than words.
Their focus on the renewable energy sector, their aggressive capacity expansion, their push into international markets, it all paints a picture of a company that's ambitious, growth-oriented, and not afraid to take calculated risks.
And their financial performance suggests they have the resources and the discipline to achieve their goals. They're generating strong cash flow, have a healthy balance sheet, and consistently deliver impressive margins.
But we have to acknowledge that the market is a dynamic beast. New technologies emerge, competition intensifies, and global economic conditions can shift rapidly.
Exactly. Predicting the future is impossible. But Shilchar seems to have the agility and adaptability to navigate whatever challenges come their way. Their willingness to invest in innovation, both in terms of product development and operational efficiency, suggests they're not content with resting on their laurels. They're constantly striving to improve and evolve.
So where does this leave us in terms of assessing their long-term prospects? It's a bit of a mixed bag, right?
It is.
They have a lot going for them, but there are definitely some risks to consider.
It's hard to say definitively whether they can maintain this incredible growth trajectory. The market is too unpredictable for that, but they've positioned themselves well for success.
And that's what makes this deep dive so fascinating. We've gained a deep understanding of their strength, their challenges, and the factors that will shape their future.
Now, as we wrap up this part of the deep dive, I want to leave our listener with a question to ponder. Imagine you're on Shilchar's board of directors. Knowing everything we've discussed so far, what would be your top priorities for the company's future?
That's a great question. What strategic moves would you recommend to ensure their continued success in this rapidly evolving market?
Would you advise them to double down on their renewable energy focus, perhaps exploring new niches within that sector? Would you diversify their product portfolio, targeting new industries or applications for their transformers? Or would you accelerate their international expansion, seeking to conquer new markets and build a global brand?
These are all important questions that Shilchar's management team is likely grappling with right now. And the decisions they make will determine the next chapter in their story.
And as we move into part 3 of this deep dive, we'll explore some of these potential paths forward and consider the key takeaways for our listener, whether they're an investor, an entrepreneur, or simply someone who's fascinated by business and innovation.
So stay tuned for the exciting conclusion of our deep dive into the world of Shilchar Technologies. And we're back for the final part of our deep dive into Shilchar Technologies. It's been quite a journey exploring their incredible growth story.
Yeah, we've covered a lot of ground, haven't we? From their financials to their strategy, their focus on renewables, and even the challenges they're facing.
We've seen how they've transformed from this steady player to, like, a company on fire experiencing this explosive growth. And we've analyzed the factors that are really driving this remarkable transformation.
But now it's time to distill it all down right.
Right. What are the key takeaways for our listeners?
Exactly. We're not just here to throw a bunch of data at you.
We want you to walk away with some actual insights. Whether you're an investor thinking about Shilchar, an entrepreneur navigating a similar market, or just someone who loves understanding how successful businesses work.
So let's start with one of the most striking things about Shilchar's story. The power of specialization. They could have easily tried to be everything to everyone in the transformer market, offering a wide range of generic products.
Right, just trying to be a jack of all trades.
Exactly. But they made a conscious decision to focus on a niche. Customized transformers for the booming renewables sector.
And that focus has been like rocket fuel for their growth.
It really has.
It's allowed them to build this deep expertise, a strong reputation for quality, and those tailored solutions that we talked about. And of course, they can command premium pricing.
It's a great lesson for anyone in business. Identify those emerging trends, carve out your niche, and become a leader in that space.
Find your sweet spot and hit it out of the park. But it's not just about finding the right market. It's about executing efficiently and profitably. And that brings us to another key takeaway.
Operational excellence.
Shilchar's lean and mean approach, focusing on assembly and outsourcing those lower value add components, has been key to their incredible margins.
They're not just throwing money at growth, they're doing it strategically and efficiently.
They're running a tight ship, for sure, and it's reflected in those strong financials we talked about.
Speaking of strong financials, let's not forget about that debt-free balance sheet.
That's a major advantage.
It gives them the flexibility to reinvest in the business, weather economic storms, and seize opportunities without being weighed down by debt.
It's like they built their business on solid rock, while some of their competitors might be on shakier ground.
Exactly. And this financial strength gives them the freedom to make those bold moves, like that aggressive capacity expansion and their push into international markets.
And speaking of bold moves, let's talk about the people making those decisions. Their management team has demonstrated a real knack for anticipating those market shifts, adapting quickly, and executing effectively.
They're not just riding the wave, they're steering the ship.
From expanding capacity ahead of demand to strategically targeting the private sector and venturing into new international markets, they've made some really smart calls.
And they're not afraid to bring in fresh perspectives. That blend of experience and youthful energy in their leadership team is a valuable asset.
It's like they've got the wisdom of a seasoned captain, combined with the enthusiasm and new ideas of a young crew. A perfect recipe for navigating those uncharted waters.
And charting a course for long-term success.
Exactly. But we can't just get swept away with all the positives.
Yeah.
We also need to acknowledge the potential risks. Competition is heating up raw material. Prices can be volatile. And that global economic landscape is always uncertain. And while their focus on renewables has been a winning strategy so far, it does mean they're concentrated in one area.
It does.
It's like they've built a beautiful house, but it's in a hurricane zone. They've got to make sure they have the right insurance and safeguards in place to weather any storms that might come their way.
Exactly. It highlights the importance of diversification, both in terms of their customer base and the products they offer.
Spreading the risk.
Right, and it's a good reminder that even the most successful companies aren't immune to those external forces.
So as we wrap up, let's bring it back to our listeners.
What can you take away from Shilchar's story?
Well, we can't tell you whether to invest in them or not. That's a decision you need to make based on your own research, your risk tolerance, and your investment goals. But what we can do is give you the insights and the framework to make a more informed decision.
By carefully analyzing a company's business model, their financials, their management team, the competitive landscape, and the potential risks and opportunities, you can start to form your own educated opinion.
And that's what this deep dive has been all about, giving you the knowledge and the confidence to navigate the world of business and investing.
Now, as we close the book on Shilchar Technologies, we want to leave you with one final thought, a question to ponder, a spark to ignite your own curiosity.
Ooh, I like that.
Imagine you're at the helm of Shilchar. You're guiding this company through the choppy waters ahead, knowing everything we've discussed. What would be your top priority? What moves would you make to ensure their success in this ever-changing world?
Would you double down on their renewable energy focus? Maybe explore new niches within that sector? Would you diversify their product portfolio, target new industries?
Or maybe accelerate their international expansion, go after new markets, and build a global brand?
The possibilities are endless.
They are.
And the choices you make will determine the fate of this company. We hope this deep dive has given you a glimpse into the exciting world of business and investing, and inspired you to explore further, to ask those tough questions, to challenge assumptions, and to never stop learning. Thanks for joining us on The Deep Dive.